Hello, this is Jordan, and this is your precious metals video market update. This video is being recorded on the evening of Thursday, March 30th, 2017. And in this video, we're going to discuss why we see increasing downside risk for precious metals this spring, of course, with an emphasis on the miners. In this first chart, we plot the daily candle charts of the US dollar index, the 10-year bond yield in the middle, and the S&P 500 at the bottom. And a few weeks ago, we were showing a similar chart to this, where we saw yields coming down, the dollar going down to test its support there at the 200 and 400-day moving averages. And because of those reasons, we thought precious metals had a little bit more upside. That did play out as we expected, although the miners have been very weak, which we'll get to. But the setup right now is troubling for precious metals. First of all, the US dollar index. Now, we're showing a daily chart here, but if you look at a weekly chart, it has put in a pretty good bullish reversal. And you can see on the daily chart that it didn't quite touch the 200-day moving average, but it came really, really close to it at 98.52. So, and then after that bullish hammer, I mean, it's had 3 strong days moving up. So the uptrend in the dollar is well intact. I mean, I don't see any topping formation here, bearish price action. Again, I mean, it rebounded nicely off its rising 200-day moving average. So that's bullish for the dollar going forward, and obviously bearish for precious metals. Now, the 10-year yield, that, as you can see, the yield has come down from about 260 recently down to about 235 or so. It closed today at 2.42. We'll round it up. But it's been trading in a range since December, and so it's been trading in this range from 2.30 to 2.60. And first of all, if we saw this yield break out above 2.60, that would be very bad in the medium term for precious metals. Rising interest rates are not good for precious metals unless inflation is rising faster. And if you look at energy prices, they are weak. They could potentially be rolling over, and so that could prevent inflation from rising that much faster. So that's my fundamental explanation there, why rising yields would be negative for precious metals, at least in the short to medium term. But the 10-year yield, I mean, for it to be negative for precious metals, it doesn't have to break above 2.60. It could just rally up to 2.60. And so that could be negative for precious metals over the next couple weeks or the next month. And also, I mean, another issue is the S&P 500, which has made a pretty strong bounce here off its rising 50-day moving average. Now, unless we see some major selling come in immediately and drive this thing back below the 50-day moving average, then we have to assume that the stock market is going to continue to be stable to strong here in the short term. And so if you've watched my recent videos, you'll know how I believe that precious metals really need to see weakness in the stock market for them to really get going and for their bull market to really be reignited. And so this rebound in the overall stock market is troubling for precious metals, and especially if it sustains itself here above the 50-day moving average. Now here we look at the daily bar charts for most of the complex, and we have gold, silver, GDXJ, GDX. Now gold has rallied back to its 200-day moving average. We can essentially say, I mean, essentially it did rally up to its February high at 1264.9, but it hasn't gotten above 1262. So to be precise, it is about $3 an ounce off. But I mean, compared to silver and the miners, gold is showing more relative strength. And even silver, I mean, some people I've seen, they're talking about silver showing some strength. I mean, I don't see anything special about silver here. I mean, it's showing strength compared to the miners, but not compared to gold, because silver hasn't rallied back up to its late February or early March high there. And even if silver were to rally back up to that point, we would need to see a daily close or a weekly close above 1850 to 1875. I mean, that is really, really strong resistance in silver, and I don't think it's going to get above it on this move. And also, with respect to gold, if gold is down $10 or $15 tomorrow, I mean, a lot of weird things can happen at the end of the quarter. But gold in the last couple of days may have put in a top here. And so if gold is down $10 or $15 in the next day or two, that could confirm that it's put in a short-term top here. And I mean, it could come back down and test 1200 to 1220, which is really, really important support. Now, to get to the lower half of this slide, I mean, the biggest problem here for precious metals is that the miners have been lagging big time. I mean, for almost 5 or 6 weeks now. I mean, they peaked in early to mid-February, and I mean, they did on this recent move, they didn't even come close to their February highs. Whereas silver has come fairly close, gold has come within, $2 or $3 an ounce. That's just, it's terrible relative, just a huge relative weakness. I mean, it's just terrible relative weakness in the miners. You can see they're clearly below their 200-day moving averages, which are flat. And, the GDX looks like its moving average is starting to slope lower. GDXJ is also going to slope lower. Just an important point about moving averages. The slope of the moving average is really important. Just a little something I wanted to mention here. But the 200-day moving average is really the most important moving average to focus on. As I said, the miners are trading well below that. The miners are also trading below the 50-day moving average, which is sloping lower. So it's just really weak action for the miners, and I think they're headed for a test of the March lows. That's 32.50 to 33 for GDXJ, and for GDX, that's around 21. And let's take a look at the advanced decline line for GDX. I mean, the AD line is really the holy grail of leading indicators. Go back to late 2015, early 2016. I mean, look at the AD line. It was strong there. It was showing a positive divergence. It actually bottomed at a rising 50-day moving average there in January. That's when the sector started to get going. So there was a clear positive divergence there for the advanced decline line. And also, if you look at, just go to October and November, and you can see the advanced decline line, while trending down, most of the time it was trending sideways. Actually, from mid-October until mid-December, there was a point where the advanced decline line was trending sideways, yet GDX at that same point in time was down about 10 or 12%. I mean, you can see the advanced decline line. Most of the damage was done in September, and then not as much damage in October and November. So the lack of big weakness of the advanced decline line in the fall and at the end of fall, that was a positive, and somewhat of it wasn't predicting that we were going to get a huge rally, but it was definitely a sign that the internals of GDX were much stronger than GDX itself, and that in itself was a leading indicator. And so unfortunately, what we see right now is the advanced decline line is weaker than GDX. I mean, since the peak in February, it declined very strongly, and the rebound in the advanced decline line over the last month or so, or 3 weeks, has just been really weak. And you can tell because it didn't even come close to its 50-day moving average. And it looks to be petering out here well below its 50-day moving average. Whereas if you look at GDX, it rallied up to its 50-day moving average and it tested it. We can see a couple times, and now it looks like it's rolling over. So not a good sign here. I mean, we already noted the weakness in the miners relative to the metals, but on top of that, the advanced decline line for GDX, I mean, that just kind of, it's just another real negative sign for the miners. And in this slide, we're looking at the weekly bar charts, a GDX on top, GDXJ at the bottom. In the past 2 weeks, I mean, before this week, but the previous 2 weeks were really bearish in my opinion, because the miners saw gains both those weeks. At the close of both weeks, they saw gains, but where they actually closed, they lost bigger gains. So in the previous 2 weeks, the miners were unable to close near the highs of those weeks. And that, again, that's just a sign of weakness. That's a sign of distribution, that people are taking profits and selling. They're not holding their positions into the weekend. So, I mean, not good there. And we're seeing another bearish candle this week. I mean, it's pretty obvious. I mean, depending on, I mean, even if we're up tomorrow on Friday, I don't think that really doesn't change the candle, in my opinion. So it's just weak price action any way you look at it, and implies we're going to see lower prices. I mean, to change my opinion, we would need to see a weekly close in GDX and GDXJ above the highs of this week. So, like, if we're looking at GDX, I mean, if it made a weekly close at 24, I mean, a weekly close there, that would be encouraging. That would tell me it's probably going to rally up to 25, 26. And same thing for GDXJ. I mean, if it was able to make a weekly close, above 37, maybe the mid to high 37s, even if it was able to do that, that would imply that it has a good chance to rally up to that red resistance there around 41, 42. But it just doesn't look to me like that's going to happen. I mean, based on the price action that we're seeing, and let's focus on GDXJ because we focus more on the juniors. I mean, it came all the way down to major support around 27. It had a big rally up to that first major resistance there, had a sell-off, and now the rebound is kind of fizzling out. The odds favor this coming down and testing the blue before testing the red again. And so that's something that I think we really need to focus on, is let's be patient here. Let this thing play out. Let it come down. I mean, the odds are saying that it's probably going to move lower, not higher. And just be patient here. Wait for that to happen. Wait for things to get really oversold. And if we see GDXJ getting really oversold and coming down to retest the December lows, that's likely going to be a very good buying opportunity, and it very well could be the most significant bottom, since the January 2016 bottom. And another thing I'll add is the one positive thing right now for precious metals is sentiment is not super bullish. It's kind of neutral. I mean, I've seen people on chat boards and those types of plays, they're saying, well, sentiment's really bearish. I wouldn't say it's really bearish. I'd say, I mean, based on the things I'm looking at, it's kind of neutral. Based on the hard data and those types of indicators, it's neutral to me, and that won't prevent precious metals from having a bigger sell-off. But if we do get a bigger sell-off here in the spring and we see miners coming down to retested December lows, that will tell us that, after that sell-off, sentiment will, at that point, it will then be really bearish. And that's what you want to see, especially if you have GDXJ testing 27 and really strong support. I mean, it's the three things I look for when you want to try and buy a low in the market. Number one, you want the market to be really oversold. Number two, you want it to be at a point of really strong support. And number three, you want sentiment to be bearish. And it looks to me like, I mean, again, it'll probably take a couple months for us to know if we're on track or not. But it looks to me like we could get those things if the market comes down and tests 27. Again, GDXJ, if GDXJ does that in the next couple months, it could be another fantastic buying opportunity, and that's what I'm waiting for. Well, thank you so much for sticking around to the end of this video, and you can follow all of my work at thedailygold.com, and on my homepage there, opt in there near the top, you can get my 2017 market outlook for precious metals, and if you do that, then every Sunday for as long as you wish, you'll get my free newsletter, which has my most recent thoughts on the sector and some snippets from my premium update the day before. And also, you can consider my premium newsletter. It's only $149 for 6 months. Go to thedailygold.com/premium. We can help you write out the volatility in this sector over the next several months and get you to be in good position for when the sector is ready to launch again, to get you in the right fundamentally strong companies. Well, thank you again for listening and watching this video. I really appreciate it, and I look forward to publishing another update for you in the next couple weeks.